Car prices are near all-time highs, and yet sales are rising, and that's mainly thanks to the rich. 8 months into 2025, the share of new cars costing more than $50,000 is almost double what it was 6 years ago. And it's not just because automakers are charging more across the board. It's because the share of vehicles at the highest prices has grown.
Reality is, the automakers are in the business to make money. And this market, because of higher income households buying a greater percentage of the vehicles, has shifted to the upper end. Like it or not, that's the reality if you look at the numbers.
While dealer profits were up 20% in Q2 2025, economists are concerned. A lot of Americans are struggling to pay bills and get loans. Meanwhile, companies are growing ever more reliant on a smaller share of consumers for sales.
If that bubble bursts, that has pretty dramatic implications across the economy because so many companies have become so focused on catering to the demand of those high-end consumers.
We either need a much more viable, lower cost alternative, or something needs to happen in the financial markets that really loosens the ability for those buyers to purchase.
CNBC dove in to understand why the rich are propping up the new car market and what it says about the U.S. economy. In 2019, just about a quarter of new cars cost more than $50,000. Now, it's nearly half. Just about 7% were over $60,000. That number is nearly quadrupled. And above $70K, that has more than tripled. The average monthly loan payment was $749 in the second quarter of 2025, almost $200 more than it was in the same period of 2019. Leases were $612, also up. About 15% of monthly payments, including leases and loans, are over $1,000. There's something to be said for the idea that popular cars these days are just built to be expensive. Increases in new technology, safety equipment, some of which is federally mandated, new powertrain investments such as fuel efficiency and hybrid and EV battery technology, meeting stringent US regulations, and providing choice, these all cost money.
We have over 600 variants in the market. We have a regulatory environment that requires homologation. It's incredibly expensive.
But some numbers suggest car prices haven't risen that much compared with other metrics. Based on government data, motor vehicle prices have outpaced overall inflation by a bit, but not overall wages and salaries. On average, customers are paying about $49,000 to purchase a car. That, of course, is an average. About a quarter of new car sales went for less than $35,000. What is really going on is automakers are selling a lot more of far more expensive vehicles, and those cars are pulling up the average transaction price. The share of buyers with more than $150,000 in income made up 12% of all purchases in 2025, more than in 2019. That group is roughly at least twice the size of any other income group among new car purchasers. Here's a snapshot of the 10 most popular vehicles in America and what they sold for in June 2025. Of them, 5 are pickup trucks, and all of those, except the mid-sized Toyota Tacoma, cost more than $60,000. In the US, there are more vehicles for sale above $100,000 than there are below $30,000. That doesn't include exotics like Ferraris.
This started during the chip crisis, when the automakers were restricted with how many semiconductors they could get. What did they do? Well, they're smart business people. They prioritized making the most profitable vehicles, the highest priced vehicles, higher end vehicles, and they sold, mainly because there was limited supply out there. And that was the beginning of the shift within the market.
Add to that tariffs, which are adding up to $5,700 to the price of each imported vehicle.
The reason that's important is because it's had a disproportionate impact to the lower entry-level models, just reducing that inventory and availability.
Some economists say what is happening in the auto space is an indicator of a much larger economic phenomenon.
In terms of overall consumer sentiment, gap between high and low income adults and our Morning Consult's daily data is as wide as it's ever been. It's true in purchasing intentions for new autos. It's true in some of the household financial decisions. It's true in labor market outcomes. And so I think that's a defining feature of the US economy right now.
There are several reasons for this gap. 1. Low-income people have less cash for cars because they're spending it more on other things than they used to. A car is the second biggest purchase a household is likely to make. The first, housing.
Housing prices have risen dramatically, rents have risen dramatically for middle income and lower income adults and households.
The 2024 Treasury report showed that more than 90% of Americans lived in counties where house prices and rents outpaced income over a 20-year period.
I think that's because we face a chronic housing shortage across this country. And so, if you own your house right now and you're benefiting from elevated house prices and those higher asset prices, you're feeling pretty good, actually. Conversely, if you're renting, you're in a really weak position. And so I think part of what we're seeing is actually just that the share of wallet available for autos has been reallocated to other spending categories, particularly for the middle and low income adults.
But it's not just rent. Overall inflation has been one of the biggest stories of the pandemic and post-pandemic era. Meanwhile, in addition to being more likely to own a home, wealthier people are also much more likely to be investors. Wealthy customers have benefited greatly from a healthy stock market in the last several years. 68% of high-income individuals have at least $50,000 invested in stocks. Starting in early 2022, the Federal Reserve raised interest rates pretty aggressively to combat inflation.
Interest rates started going through the roof, and most people do purchase by monthly payments. And so that really started to price a lot of people out of the new vehicle market.
Rising interest rates are also a factor in another bigger piece of this story, the credit crunch. Lower income households have had a harder time getting credit. Super prime buyers, that is, those with credit scores above 781, are the only ones getting more new auto loans than they were several years ago. All other tiers have mostly shrunk, subprime the most.
Banks are a little less likely to move into that subprime space right now, coming out of the Dodd-Frank regulations that came in from 2008, 2009. And so that's a blessing and a curse.
Dodd-Frank is a nickname for a bill enacted in 2010 in response to what critics called predatory lending practices. Among other things, it included a rule that required a mortgage lender to ensure a borrower would be able to repay a loan before extending credit. The bill expressly excluded auto dealers from such oversight, but Lear says the overall lending landscape has become more conservative in its aftermath anyway.
The broader sort of regulatory shift over the last 10 years has been to say, actually, we believe that some level of interest rates are predatory. And so as a result, people who are very, very risky, in other words, the likelihood that they're going to repay their loan on time and in full, has essentially become too high certainly for banks to take on.
If they get the loan, they have a higher interest rate because they have a lower credit score.
Higher interest rate contributes to a higher monthly payment, then impacting the affordability challenge, then requiring a higher income amount to be able to qualify for that payment to income. So it's almost like a circular effect that's what's going on.
Data shows that in Q2 2025, auto loan delinquencies, or late payments, have nevertheless increased year over year and have been increasing since 2021. Lower credit consumers will have far higher payments for a car of the same value because their interest rates are just so much higher. On a $48,000 car, again, roughly the average price, super primes will pay $832 monthly and $54,165 total. Deep subprime buyers, if they can get a loan, pay on average $1,145 a month for $73,501 total.
There are things that are complicating, like personal finance, for the lower income quintiles, and there are things that are making upper income quintiles even more secure. The wealth effect, great deals for people who have good credit rating.
Automakers aren't the only ones chasing the rich.
I think broadly for our economy, the wealthy buyer is holding everything up.
That means companies might be risking their futures on wealthy customers.
If that bubble bursts, that has pretty dramatic implications across the economy because so many companies have become so focused on catering to the demand of those high-income consumers.
This is where the worries start. First,
middle and low-income folks are directly feeling financially pinched and they're experiencing financial hardship. That's worthy of concern on its own.
But there is another concern. That high-end market is showing some cracks.
Every day we're interviewing 5,000 adults, and that high-income group for the last 4 days has shown pretty dramatic decreases in consumer sentiment.
In another survey, Morning Consult asks about 10,000 adults every 7 days if they lost pay or income that week. For the first week in a long time, it saw a slight increase in high-income adults who said that they had experienced some kind of loss or pay or income.
And for the last 2 months, that high-income group has been remarkably resilient despite whatever we threw at them. Tariff announcements, layoff announcements, whatever. They said that they were confident about the economy and that they were, all gainfully employed. And over the last 5 days, we see signs that that is starting to change.
So if the industry wants to keep selling cars, it might have to figure out a way to either sell cheaper vehicles or get credit to a wider range of buyers. Some signs indicate buyers with more recent loans, those issued in 2023 and onward, are having an easier time paying them off. Lenders are noticing.
They are starting to make credit available again. So the credit availability index has been improving.
Industry analysts like Keating say one obvious source for less expensive cars may be a country the US government has erected stiff tariffs to keep out: China. Chinese manufacturers have gained an international reputation and stoked fears among global giants for their ability to make competitive vehicles at low prices. Cox's research among both dealers and consumers shows that many of them expect Chinese vehicles to arrive in the US one way or another.
A lot of dealers say, we'll sell them. Sure. Why not? Why wouldn't you want a profitable franchise that is selling a wanted and needed commodity, such as a less expensive vehicle? We have the market for it. Why wouldn't a dealer want to do that and get into that business? Volume matters.
Just knowing the auto industry in general, the industry is very resilient. We've been through challenges in the past with the 2008 crisis, the COVID situation, now tariffs and vehicle availability and consumer affordability. I have no doubt the auto industry will persevere through these challenges.